So, in this session, the major agenda is that we're going to talk about ROE and ROCE analysis. Just let me know if I'm audible to all and visible to all as well in the chat box. That would be great from your side. And then we can begin with the discussion for today. Analysis for the ROE and the ROCE. So ROE, as we all know, is a return on equity. And ROCE, thanks Umesh, thanks Raghav, I'm audible and I'm visible clearly. Okay, so I'll share my screen as well for the continuation of this session. Just let me know if my screen is visible to you as well. Just give me a confirmation. And if anywhere you find my connectivity is not good, like just let me know in the chat box. I'll just improve the connectivity. Okay, so yeah, the discussion for today, talking about the ROE and the ROCE analysis. So ROE, as we all know, is your return on equity, correct? And your ROCE is your return on capital employed. So firstly, without wasting any time, I'll just write these two terms. One is your ROE and the other is your ROCE. Okay. So your ROE is the return on equity and your ROCE is the return on capital employed. So first of all, we know that these two metrics are one of the most important ratios which the financial analysts tend to consider when they're analyzing a company or trying to compare the companies within the same sector. Ideally, ideally, if someone asks you that like what is the ideal ROE or ROCE ratio in a company? Ideal return on equity or ideal return on capital employed, that what is a ratio which the financial analyst might be looking into place before investing into a company or before recommending anyone to invest into that target company. Ideally it should be in two digits. Okay, up that two digits obviously should not be too high, 50%, 60%, 80%, right? It can be for a startup company. A startup company might have a return on equity or your return on capital employed higher one if it is making a profit, only if it makes a profit. But in the present scenario, we can see that most of the startup companies are the loss-making companies, right? And in those scenarios, we cannot calculate the return on equity or the return on capital employed. So ideally, for the normal companies who are the profit-making companies, we expect a return on equity or a return on capital employed ratio to be at least in the range of like 13 to 17%. If a company is giving you a return on equity or like simply the return on capital employed between the ratio of 13 to 17%, that is ideally considered to be good. A normal company having a good expected ROE, a decent ROE. So we can think of going and try to like invest into that company or look forward toward that company. So that things we can do if a company is having a decent range of 13 to 17%. Good companies and decent companies can also have a range of higher than 17%, 30%, 40%, 20%. Your fast moving consumer goods industries. Like for example, your Nestle, your Britannia, HUL, these companies try to have a ROCE of more than 20% or 25% or 30% even. Here I'm talking about the ROCE or the return on equity or the return on capital employed ka growth rate, 30%, 20%. Here I'm not talking about the earnings of the company or the share price of the company. That's different. Okay. We need to have a clear cut demarcation between the two. Here, I'm not talking about the growth rate of those companies. Here, I'm talking about a specific metric. If the return on equity or the return on capital employed of a company is growing by 20%, 30%, 40%, it does not mean that the company is achieving a growth in the share price or the profitability by 30% and 40% also. Like the both can vary. It can happen that the ROC of the company has grown by 30%, correct? But the share price has just grown by 10% or 5% also. Okay, it is not mandatory that the ratio and the share price would move in tandem. Okay, so always have a clear cut demarcation. So these companies have traditionally had a higher ROCE or the higher ROE ratio. But ideally, if you want to think for a stock or go for a company, and when you are analyzing it on the basis of this metric, try to look into the ROE and ROCE having a 13% to 17% ka ratio, along with the other metrics as well, which I have told you in the previous sessions. Okay. So now we need to understand the difference between your return on equity ROE and the return on capital employed ROCE. So like whenever we are talking about the return on capital employed, okay, or like first let's begin with the ROE. Okay, so starting with the formula, your formula is nothing but your profit after tax by the number of outstanding shares. So profit after tax is nothing but your EBIT, your earnings before interest and tax, minus your interest payment, minus your tax payments, divided by the number of outstanding shares in the company or the number of the floating shares in the company which people are buying and selling in the stock market. Okay. Also, if you dig deep into finance, if the company is paying dividends as well, sometimes it happens the company is paying dividends. Then first we have your earnings before interest and tax EBIT. If I just write in here, you tend to subtract your interest payment and then your tax payment. You tend to get your profit after tax. If the company is declaring dividend, you tend to subtract your dividends as well after the tax payments. What amount of dividend the company has paid. Though we can also call it as a profit after tax. A large number of people tend to call it as the profit after tax only, even if the dividends have been paid. But a more appropriate term for the students of finance is EACS. EACS. It is your earnings available to common shareholders. E stands for earnings, A stands for available, C stands for common, and S stands for shareholders. EACS. So we can just try to modify this formula and try to write EACS, earnings available to common shareholders divided by your outstanding shares. Okay, earnings available to common shareholders divided by the outstanding shares, because you tend to differentiate yourself from the different students. सब पैट बोलेंगे तो मैं earnings available to common shareholders बोलना है if the dividend has been paid. If the dividend has not been paid, then call it PAT. Okay, the profit after tax. So formula says your earnings available to common shareholders divided by your outstanding shares. So ideally, this ratio should be as high as possible, because ultimately this ratio is telling you that how much earnings are available to the outstanding shareholder, that is the person who have contributed the money into the company, or the people who have invested their money into the company, how much money they are earning upon the basis of their investments. If on 1 rupee I can make 10 rupees, so that is good for me. If on 1 rupee I can make 20 rupees or 30 rupees or 50 rupees, so that is good for me. So similarly for the return on equity, what the capital providers, the equity capital providers of the company are getting on the basis of their investment. 1 रुपये पे उन्हें कितना मिल रहा है? 10 रुपये, 20 रुपये, 30 रुपये. So that is your return on equity, right? But like one thing we need to understand, your return on equity, it takes into consideration only the company's equity, the shareholders, and not the debt holders. So one thing you need to take into consideration is if the company is having just equity, if the company has taken no debt, the company has zero debt or negligible amount of debt, in that case, you people would be using the return on equity only. And in that case, your return on equity and the return on capital employed would be same, because basically the company has just equity only. But if the company has debt, if the company is having debt, then using ROCE or the return on capital employed would be more appropriate, because your return on capital employed, it takes into consideration the equity as well as the debt. So whenever you have debt in the company, a significant amount of debt, okay, always use ROCE. The formula is nothing but your EBIT into 1 minus tax divided by your equity plus debt, or the total capital employed, we also call it as, because your capital employed is nothing but your total amount of equity or debt. How does the company get money? The first source of money, in a broad sense is to the equity holders, because people tend to buy the shares of the company and the money goes to the company in case of a primary issue. Correct. And then the debt. If the company wants to raise money, the company can issue bonds or debentures, and people would be subscribing to those bonds, and the company would be getting the money. In return, the company would be promising a fixed rate of interest or a floating rate of interest to those people, right? So, like, that is the thing. So, but like whenever the company has debt along with equity, I would suggest always use the return on capital employed and not the return on equity. It can happen. Just assume a situation the company has debt, right? And equity both. And they're still using the return on equity ratio. It can happen the return on equity ratio may be inflated. Why? Why this ratio will be high? Mathematically, the ratio will be high when the denominator is less and the numerator is more. Correct. So in the denominator, your ROE ratio will just take into consideration equity and not the debt. So as a result, the ratio will tend to get inflated. You might get a higher figure, 20%, 30%, 40%, or 50% even. But when you calculate the ROCE, that amount of 30% or 40% might come down to just 50% or 20%. Because here in the denominator, you are taking both debt and equity, and the value of the denominator has risen. Hence, mathematically, the value of the ratio will come down. So this artificially overinflated ROE will not give you a true picture if the company has debt. So as a result, you always have to use a return on capital employed if the company has debt. If the company does not have debt, your ROE will be equal to ROCE. Okay. But now the question arises, why in the formula for your ROCE, I have taken EBIT into 1 minus tax and not the PAT or EACS. So one thing you need to understand is that whenever we are talking about the return on capital employed, we're talking about the return that the company is giving to all the capital providers of the company, be it the equity holders or the debt holders. In case of return on equity, they're just bothered about the equity holders and not the debt holders. So tell me one thing, that whenever we are bothered about both the equity holders and the debt holders, in case of your return on capital employed ratio, your EBIT or the operating profit is something which is available to both the equity holders as well as the debt holders. Correct? If you are subtracting the interest payment from EBIT, it means the debt holders have been satisfied. The money has been given to the debt holders. Correct? So the debt holders are happy. Okay, gone. So after those interest payment, the money that is available to the equity holders only. Correct? So once the interest payments have gone, the debt holders are satisfied and the money is available for the equity holders. That is what we are doing in case of ROE. We have excluded the impact of debt. The debt holders are satisfied and happy because they've got their interest payment. And now we have to just take into consideration your equity holders only, right? But in case of EBIT, we are like bothered about both the debt holders as well as the equity holders. That is why we are not subtracting the interest payment from that, because that operating profit is available to all the capital providers of the company, majorly equity and debt. And the second reason is there should be consistency of multiple. Like whenever we talk about valuation, like one of the most important things like that we learned in the assumptions of valuations is that the multiple must be consistent. It should not be that you have taken all the things like which are available to equity in the numerator, and you have taken both the equity and the debt holders in the denominator. For equity, your basically the part of numerator should also indicate the equity part, and your denominator should also directly or indirectly indicate a component of equity only. It cannot be that in the numerator you guys have taken PAT, and in the denominator you guys are taking both equity and debt. So that's not consistent, because the numerator shows that we're talking about the profit like which is available to the equity holders only. Then why you are taking into consideration your debt holders and equity holders in the denominator part? Correct? So in order to have consistency of the multiple also, we tend to take into consideration a related part in both the numerator and the denominator part. Okay. So one thing is clear, the difference between the return on equity and the return on capital employed. When the company has debt, when the company has debt, ignore the ROE ratio. ROE ratio को देखना ही नहीं है. Look at ROCE. But when the company does not have debt, तो ROCE देखो चाहे ROE देखो. The values of both the ROE and ROCE would be same. Any questions till now? Let me know if you guys have any question. Or is it clear? Clear. Thanks, Umesh and Satyam, for being so active in the chat box. Ropali, Payal, Tayyam, Harshit. Thanks. Thanks, Harshit. Thanks, Gansham, Nidhi. Okay, so no queries as of now. So one thing, like one more thing we need to talk about is the decomposition of ROE. Okay, the decomposition of ROE, that is, I'll be breaking down ROE into three formulas, into three financial ratios, which we have already talked earlier. We can decompose the ROE by using the Du-Pont analysis or the Du-Pont formula. So what does it basically say? It tends to break down the ROE of the company into your profit ratio, right? The profitability ratio, which will be nothing but your net profit by your sales, into your asset turnover ratio, which will be nothing but your sales by your assets or total assets, into your what? Leverage ratio, that is assets by equity. Ideally, like mathematically, we can just cancel out sales and asset and asset. And once we cancel it out, your formula comes out to be your profit after tax or the net profit by equity, like that we learned, right? So basically, in the ROE, we are trying to decompose this formula, and it is a very common question like that is asked in the interviews. That what are the three major metrics of which the return on equity is composed of? The three major metrics of which the return on equity is composed of. So people can directly say the profitability metric, right? The profit ratio, the assets turnover ratio. The formula for the asset turnover ratio is sales by total assets into the leverage ratio. The formula for the leverage ratio is assets by total equity. So by net profit to sales ratio, we know that how much profit the company is able to make on the amount of sales. If the company is doing a 1 rupee sale, how much profit the company is making on that 1 rupee sale. Higher the ratio, it is good for the company. A company must have a net profit to sales ratio or a profitability ratio as high as possible. Then sales to assets ratio. It is nothing but your asset turnover ratio. Correct? Your return on assets and asset turnover ratio are different. Correct? In your return on assets, you tend to take your EBIT in the numerator. But in your asset turnover ratio, you are taking into consideration sales in the numerator. And one more way to remember, like whenever the ratio has a turnover word, asset turnover, fixed asset turnover, or current asset turnover, or like whatsoever, the bit turnover ho, you always use sales in the numerator. And whenever the return is mentioned, the return on fixed assets or the return on total assets, so whenever that word return is mentioned, always use profit in the numerator. Okay, or your EBIT. And why EBIT in case of your return on assets ratio also? Because here we are taking into consideration the total assets of the company. The assets can be employed or the assets can be purchased by the company, taking the money either from the equity holders or from the debt holders. Correct? अगर company को पैसा चाहिए, if the company needs some money to purchase those assets, either the company would be taking money from the equity holders or issuing bonds in the economy, like which would be the money by the debt holders or the bond holders. Correct? So again, in your return on assets ratio, you people would always be using your EBIT. ठीक है? उसमें like tax payment करने की need नहीं. Okay? So asset turnover ratio, again, this ratio should be as high as possible because like whatever assets we have employed in the business, we should be able to make more sales out of that. For example, a person might be running a factory. A person has purchased some assets, a plant or a machinery. And again, those plant and machinery would be used to purchase some amount of goods. Like for example, that plant and machinery might be used to make your biscuits, your chocolates, your oiling. Like for example, for the FMCG goods. Again, those biscuits, those chocolates, those oil products, they have to be sold in the market. So directly or indirectly, that machinery is being used to make sales. Not directly, but indirectly. Directly, that machinery is being used to make goods, but indirectly, that machinery is being used to make sales in the market. Correct? So ultimately, more sales must be made from that amount of machinery or plant equipment or other kind of assets like that have been purchased. Assets are total assets, your current assets, your fixed assets, like which can be your tangible, intangible, whatsoever. Yes, so ultimately this ratio must be as high as possible because ultimately the company has to recover the cost from the purchase of those assets also. And then you have a leverage ratio. This leverage ratio is nothing but your assets by equity. Higher the ratio, it is bad for the company. If your asset by equity or your leverage ratio is high, it is bad for the company. Not always bad. I've told you in the previous session why not always bad, because debt also has an advantage. So firstly, I'll tell you that why this ratio, a higher ratio can be a warning signal for the company. Because if this ratio is high, it means the company is taking more debt to purchase the assets of the company. Or the company has taken more leverage to purchase the assets of the company. And if the ratio is low, it means the majority of the assets are being purchased by the equity or cash. Okay, but ideally, if this ratio is high even, we also need to take into consideration the other metrics also. I've tried to discuss this in my session on debt, that why do I prefer sometimes high debt companies. An article of this I've also made on LinkedIn, and a separate session is also is like available on this. So if people can go back and watch that session. Because ultimately, like if the company has taken debt and if that debt is productive, like for good manufacturing activities, for good production activities, it is good for that company. Also, if that debt will also give you tax deductibility of interest, tax advantage would also be there. And also till that point of time, when your cost of equity is more than cost of debt, the company can afford to take more debt because it will always have a magnifying effect upon the earnings per share of the firm. All these points and much more I'll try to talk about in my separate session. So please watch that. Okay. So coming to the point, it can be like risky for the enterprise if the company is having a higher leverage ratio. So now, like one thing we know that the ROE is basically composed of your profitability metric, your asset turnover metric, and your leverage ratio ka metric. So the ROA of the company, if your profitability is higher, if your asset turnover is higher, if your leverage ratio is higher, your ROE will be higher. All of these have a positive relation with ROE, and that you need to understand. If your profitability ratio is higher, if your asset turnover ratio is higher, if your leverage ratio is higher, your return on equity will always be higher. But you need to focus on one point. Higher ROE अगर the company का है, you need to be worried about this point also. You need to dig deep and find out why the ROE of the company is higher. Just if the return on equity of the company is higher, just don't blindly buy that company or go after like running after that company or try to recommend others. The ROE of the company can also be high if the profitability is less, your asset turnover is less, but your leverage ratio is high. It can happen that the profitability might not be growing by a good rate, or the sales turnover ratio might not be growing at a good rate, but the leverage ratio is growing at a very high rate because ultimately it has a direct relation with your return on equity. And why will this ratio grow? Mathematically, when the equity component has become less. And though in this ratio, we are not taking into consideration debt, but that is somewhat hidden. अगर इस ratio में equity कम हो रही है, if in the denominator equity is falling, isn't it obvious that debt is rising? Obviously. So if this ratio is falling, and when will this ratio fall? Mathematically, when the denominator is less and the numerator is high, it means the equity is falling, 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 and the assets are rising. It means the majority of the component of the asset is being purchased by debt. Since this leverage ratio is rising, again your ROE will also rise. So if your return on equity is rising on account of the leverage ratio, take a pause and try to analyze the other metrics. Try to analyze why the debt has been taken. Is it productive or not? Is the cost of equity more or less than cost of debt or not? So these things you have to take into consideration. And if you find it well, we see that the cost of equity is more than cost of debt. The debt is being used for more expansion and the productive activities. The profitability and the turnover ratios are expected to rise in further years. Because like what basically happens in your heavy industries, in the starting years, like when the company makes huge infrastructure investments, your leverage ratio is high, but your profitability, your cash flows, your turnover ratios might be low. Still, it is good for the company if those investments are productive, because these kinds of big business and heavy industries tend to have a long gestation period. And it takes time for those companies to recoup those investments or to recover that amount from those initial investments. So these things you have to take into consideration. But if these things are not there and the leverage ratio is rising, avoid that company even if the ROE is high. So always prefer ROE, taking into consideration the other different metrics which I just talked about. So the first point of discussion, the difference between ROE and the ROCE, we tried to talk about, and then we tried to talk about the Du-Pont analysis, right? So these things we tried to talk about. Any queries till now, just let me know. Any queries you have. I'll just wait for a minute. Let me know. Yes, Ritesh, in your profitability ratio, we are taking into consideration your net profit by sales. Yeah, the tax impact is there. Since the tax impact is there in your net profit to sales, it can also be like one of the reason that ये पूरा calculate करके like we are not doing like one minus tax at the end. Okay, so it is I would say like preferable to calculate your tax impact on your profitability ratio only. Instead, you do at the end one minus tax. It can again be a wrong figure, I would suggest, because sales पे तुम tax देते नहीं हो and assets पे तुम directly को tax देते नहीं हो. Correct? You always pay tax on the net profit. So calculate this tax impact on this profitability ratio and calculate it separately. Okay. Any more questions? Rehana is asking me why we are not taking into consideration debt in the leverage ratio. See, ideally, your debt is being considered, okay, but debt is not being considered directly. If assuming in your asset to equity ratio, your asset is in the numerator and equity is in the denominator. So if the equity is falling, isn't it obvious that the debt is rising? And also you need to see if the debt is actually rising or not, because it can happen that the company is making the payment through cash or the retained earnings, right? But still the equity component would be constant or the equity would be rising. The equity won't like drastically come down if the debt is not rising. So ultimately, in a 100% capital structure, the company should have a composite between debt and equity. अगर equity गिर रहा है, तो obviously the debt is rising. But the other things you people can also take into consideration if the company is making payment through cash or not. Irrespective of the fact the company makes payment through cash or not, the equity component like would remain constant. Only in the case if the debt has like come into place or not. So all the metrics, all the things like which I've told you in the past have to be taken into consideration. You cannot just come to a conclusion for the company like just on the basis of just one metric. And that is why I say work holistically. Try to take into consideration the different ratios. Okay. Question from Nidhi, sir, if the profitability ratio and the asset turnover ratio is high in this ROE and the leverage ratio is low, is it a good sign then? Obviously, it's a good sign then. Okay. And one more thing we need to understand, I would just add in, there should be a relationship between your return on equity and the price to book value ratio, right? Your return on equity and the price to book value ratio. Okay, they should have a positive relation with each other, or like both should be like favorable in a way. Because ultimately, like what happens in most of the companies, like when your return on equity ratio is rising, In most of the scenarios, the price to book value ratio will also rise. And we ideally know that the price to book value ratio must be low if you want to consider a company as an undervalued company. Because it can happen the price that the company is having is low, but the book value of the asset the company has is high. I've already like discussed this ratio also. It's market price by book value. It can happen that the book value or the asset that the company has is high and the price that the company is commanding is low. In that case, we can say the company is undervalued because assets की value बहुत ज़्यादा है, but the price at which the company is being traded in the market is low, right? But the vice versa, when the assets are too low and the price the company has is too high, it means the assets the company के पास है ही नहीं, the assets the company is not having so much productive assets, but the price at which the company is being traded is too high. In that case, we can say the company is overvalued, right? But it can also be some scenarios where that overvaluation is also tend to considered good. I've tried to talk about this concept. If the company can justify that overvaluations on the basis of its return on equity ratios, its ROC ratios, its profitability ratios, its sales ratios, most importantly, free cash flow ratios, asset turnover ratios. If all these things are rising continuously, if the market outlook is also good, if the company is making like good investments in future, if the company is going to achieve a monopoly in future, even a higher price to book value or P ratio is good for that company. That overvaluation is not always bad, but that overvaluation must be justified with the other metrics. It can happen that the company is like purchasing more and more productive assets. The assets are also rising, right? And the price is also rising by a much higher amount, right? It is not always say that assets बढ़ रहे हैं and price ज़्यादा से बढ़ रहा है. It's not always to say that the assets are bad or the assets are not productive in that sense. It can also happen that all the profitable ratios, cash flows, returns are fantastic. The assets are also rising, but the price is rising by a much higher amount. But that is being justified by the other metrics which are not part of this ratio, which are hidden. Okay. So that is why in that case also the overvaluation is justified. It's best for that company. But your ROE and price to book value must have a relationship to each other, right? They should be like related to one another, and that we need to understand. Because if your ROE is falling, right? But your price to book value ratio is rising. Okay. If your return on equity is falling and your price to book value is rising, it means the company is 100% overvalued. If the company is not having a return on equity and still the market price of the company is rising, like maybe the people are just purchasing shares in the market, like there is some irrational exuberance in the market. So what is irrational exuberance? It just means that people are like just randomly buying shares in the market because the stock market is rising and like everything in the market is rising and the shares are like not even fundamentally strong. Okay. So the return on equity is falling, but your price to book value is rising. There is not a positive correlation like between the both. So they must always move in the same direction or must always be in tandem to one another. But if your price to book value is rising, at least your ROE should also be rising. They should have a relationship. But if the both of the if the relationship is diverse, if the ROE is rising and the price to book value is falling, or the price to book value is rising but the ROE is falling, there is something wrong. Always try to maintain a relationship between the two, and that is also you need to see while analyzing a company. You need to see your ROE and price to book value together. Like one more additional point I told you, because in some advanced kinds of regression models, regression might not be too familiar with you. I'll try to have a separate session on regression models. Though I've tried to have some modules of the regression models in my curriculum only, I've included them, I suppose, like 5 to 6 months back. Like if you people have watched those sessions, auto correlations and regression sessions of the variables, dependent variables in those modules. But one thing you need to know that whenever you are seeing ROE in regression model, it is something as A, like which is your intercept, B is your slope, right? Into you can basically have your price to book value, or simply a, a better way would be I'll just have a clear whiteboard to give you more understanding. Yeah. See, your price to book value ratio is somewhat dependent upon what? your ROE, correct? So in that case, your price to book value ratio is a dependent variable and your ROE is your independent variable because ROE is not like depicted by your PB, but PB has a dependence upon the ROE, correct? So price to book value ratio, so we can write as a metric of A as the intercept, B as the slope. I would try to like discuss these concepts in that session. I won't be repeating it again, but still like if you people have queries, ask me about it. Okay. So WhatsApp, through like social media channels or like whatsoever, or in the doubt sessions into ROE. Because ROE के changes की वजह से ही a percentage increase or decrease in the ROE would be affecting that percentage increase or decrease in your price to book value ratio. If ROE is rising, ideally your PB should also rise. If ROE is falling, your PB should fall or at least remain constant, right? But agar if the things are out of the scope, if ROE is falling and PB is rising, if ROE is rising and PB is falling, something is wrong. Just try to find out the reason. Not always something is wrong. The other metrics you have to take into consideration always because the B is nothing but the slope that shows you a percentage increase or decrease in the ROE ka impact on your price to book value. So again, this regression equation is also very important in advanced financial modeling. Okay, so that you need to understand. So that is all from my side for today. Any queries on this equation? Yeah, I've been Umesh, I have a separate model like where I've talked about like what is A as the intercept, what is B as the slope, how to calculate the beta, because ideally B is nothing but your beta, right? The measure of systematic risk or non-diversifiable risk. So what is systematic risk? What is unsystematic risk? The CAPM model, all these I've tried to talk about. And I have included more modules on financial modeling, on advanced financial modeling in those modules. So like just try to watch them. Any queries, ask me in the doubt session or through WhatsApp. Okay. Can we take the return on capital employed here? Ideally, if you are trying to take a return on capital employed here, so what is the book value? The book value contains just your assets of the company, right? So in the formula part, like if we go in a bookish way, it is your total assets minus your depreciation. Fixed assets minus depreciation is the book value, correct? So in that case, even if you are using ROCE, it can be a good indicator as well because those assets can be purchased either by equity or by debt also, right? But but it would be inconsistent. Why? Because whenever you are talking about price to book value, price is just composed of your equity shares. Price is the market cap of the company. Correct? It is the market cap of the company. We call it number of shares into the price paid for it. Right? So अगर यहाँ पे हम equity shares की बात कर रहे हैं, so we can, it is preferable just to take your ROE only here. Correct? Any more questions? Did you understand like sorry, like whatever I told you today, explained you something different from the usual topics? The uh, the regression equation might be new for you. Yes, agreed. Okay, okay, no queries. Thanks. I just could suggest like if other people can also comment in here. Yeah, good. Okay then. If no queries for today, then we can end the session and get back to me for any queries. Okay.